obviously, the first step is to say, well, do we have to get back to last week's lows? Was that some kind of an important message that the market was imbalanced in some way? And do we have to retest them and then maybe see if the market is in for something deeper? I don't think right now you go by the premise that, in fact, there's anything particularly different going on in this little downturn than there has been all year, which was, you had this great year and huge momentum coming into the year. Everyone knew that earnings were going to be excellent. That's been the premise of where we are right now. And honestly, I don't think the market owes you terribly much. We're up 4% on the S&P right now after 20% last year. And there you have the S&P with the line drawn at last week's lows. We spent an awful lot of time all year toggling above and below that level. Let's call it 2728, 2750, whatever it is. But I do think that you guys have touched on this. There's really nothing whatsoever atypical about how this market has been acting since that big two-day shock last week. You have these kind of rallies that fade. People press when the market gets some downside momentum, and then it gets squeezed to the upside. And it's just sort of the market trying to find its level. 1% moves in the last 7 days. It tells you the market's on alert for something. It's obviously the weakness in global equities and potentially global economies, but also just this higher range of yields and an expensive market. If the yields are going to go up, parts of the market are not yet valued for it. So I think all of it's the same. Seasonal factors start to get positive. So I don't think that you want to necessarily assume that that anything particularly has ended with this downturn. The question is just how much of an adjustment, how painful it might be if we need to kind of probe the lows again.